A very good morning, ladies and gentlemen. And on behalf of ICPAS, the Institute of Certified Public Accountants of Singapore, I would like to extend to each and every one of you a very warm welcome to today's seminar, which is jointly organized by ICPAS and the Singapore Venture Capital and Private Equity Association, or SVCA for short. We are most honored to have Mr. Eugene Wong, Chairman of SVCA, with us today as a co-speaker. At ICPAS, one of our roles is to reach out to our stakeholders, such as the investing public, company directors, etc., and educate them on accounting-related subjects. This is important as financial reporting standards are changing at a very rapid pace. Therefore, the ICPAS Financial Reporting Committee Education Subcommittee has approached the SVCA to co-organize this seminar on the topic An Introduction to Private Equity Investments, the role that venture capitalists play, and some key financial reporting considerations. In recent times, apart from the two traditional classes of investments, namely equity and debts, a third class of investment has become more prominent, and these are collectively known as alternative investments. Excuse me. Common type of alternative investment in private equity a common type of alternative investment is private equity investment. Private equity is an ownership interest in a non-public traded company, and capital for private equity is raised primarily from institutional investors or high net worth individuals. According to one of the reading materials produced by the CFA Institute for the CFA Level 3 exams, what it says is that private equity represents an important asset class that has received increasing interest from pension plans, endowments, foundations, and corporations, and from family offices and other advisors to the private wealth market. In the days ahead, in my view, private equity may become a must-have type of asset in one's portfolio, rather than being called an alternative investment. Venture capital is a broad subcategory of private equity that refers to private equity made, typically in less mature companies, for the launch, early development, or expansion of a business. Venture investment is most often found in the application of new technology, new marketing concepts, and new products that have yet to be proven. The investment specialists who manage the venture capital are known as venture capitalists, or VCs. Venture capital is often subdivided by the stage of development of the company, ranging from early stage capital used for the launch of startup companies to late stage, and growth capital that is often used to fund expansion of existing businesses that are generating revenue but may not yet be profitable or generating cash flows to fund future growth. Entrepreneurs often develop products and ideas that require substantial capital during the formative stages of their company's life cycles. Many entrepreneurs do not have sufficient funds to finance projects themselves, and they must therefore seek outside financing. The venture capitalists need to deliver high returns to compensate for the risks of these investments, make venture funding an expensive capital source for companies. Venture capital is most suitable for businesses with large upfront capital requirements, which cannot be financed by cheaper alternatives such as debt. Although venture capital is often most closely associated with fast-growing technology and biotechnology fields, venture funding has been used for other more traditional businesses. Most VCs hope to exit from the investments by getting their investee company listed on a stock exchange via an initial public offering. With the implementation of many new accounting standards, it is of paramount importance for VCs to understand the fundamental